Everything you have been told about how companies survive inflation is entirely backwards. When consumer prices rise across the economy, the conventional wisdom says that every business must scramble to cut costs, defend its profit margins, and pray that customers do not abandon ship for a cheaper alternative. We are taught to believe that inflation is an equal opportunity destroyer, a heavy storm that beats down on every corporate ship with identical fury. But Charlie Munger knew something profoundly different. He understood that when the macro environment turns hostile and costs explode upward, elite businesses do not hunker down in fear. They use inflation as a weapon against their own rivals. While ordinary companies bleed out in a brutal race to the bottom, the true masters of pricing power quietly raise their prices again and again, turning macroeconomic pain into record cash flow. How is that even possible? And what is the hidden structural mechanism that allows a select few corporations to treat inflation like a tailwind instead of a threat? If you have ever looked at a struggling business raise prices and instantly lose its customer base, while a giant conglomerate doubles its prices and actually deepens its market dominance, stay right here, because the answer shatters almost everything mainstream finance teaches about market competition. Let us look closely at how the crowd gets this so wrong. When input costs surge, whether it is raw materials, labor, or energy, the typical business owner panics. Their immediate instinct is to freeze prices or offer discounts to keep volume high, operating under the naive assumption that volume equals health. They believe that if they can just keep the assembly lines moving and the store shelves packed, volume will save them from the rising tide of expenses. Munger viewed this volume obsession as a lethal trap. He pointed out that a business selling millions of units at zero economic profit is not a business at all. It is a charitable institution for its customers, funded entirely by the exhaustion of its owners. To understand why, we have to travel inside the mind of the consumer when economic pressure mounts. When your personal cost of living spikes, your brain undergoes a subtle shift. You become hyper-aware of where your money goes. You scrutinize routine purchases, look for substitutes, and cut out the nice-to-haves without a second thought. So why do certain brands completely bypass this psychological filter? Why do consumers cut out groceries, entertainment, and clothing, yet continue paying steep, rising prices for a tiny handful of indispensable products and platforms without a single moment of hesitation? The secret does not lie in flashy advertising or clever marketing campaigns. It lies in the brutal reality of switching costs and operational indispensability. Consider a small software tool or specialized component that a business relies on to run its daily payroll or manage its core infrastructure. If the provider of that tool increases its price by 15% overnight, what does the business owner do? Do they cancel the subscription to save a few dollars? Of course not. Because the financial and operational chaos of ripping out that system and retraining staff on an unproven alternative would cost 10 times more than the price increase itself. The vendor holds all the cards. They do not need to negotiate, they do not need permission, and they certainly do not fear competition. They simply pass the full weight of inflation straight through to the customer, while the customer absorbs it as just another cost of doing business. This brings us deeper into a layer that most investors entirely miss: the weaponization of cognitive friction. When a customer integrates a vital service into their daily workflow, that service stops being a financial line item and transforms into an extension of their own mental capability. You do not calculate the hourly cost of the tools that keep your professional life moving, because the moment you try to replace them, the learning curve and operational paralysis impose a psychological tax far heavier than any price hike. Businesses with true pricing power capitalize on this exact inertia. They do not need legal traps or lock-in clauses. They trap their users with pure habit, seamless integration, and the sheer dread of starting over from scratch. And when corporate treasurers review ledgers during tight economic cycles, this psychological architecture faces its ultimate stress test. Faced with mandates to slash every unnecessary expense, corporate leaders ruthlessly chop superficial conveniences that offer only entertainment or mild utility. Yet, when they look at the essential enterprise tool or infrastructure backbone, even one tagged with a sharp price increase, they approve the payment with a grimace. Cutting it would crash their entire operational engine, destroying thousands of dollars in productivity to save a fraction of that amount. The vendor knows this, the treasurer knows this, and the market quietly rewards that unbreakable dependency with unyielding cash flow. Now let us peel back another layer that separates superficial survivors from generational compounders. The unseen power of network density. In many dominant business models, value does not come merely from what the product does, but from how many other people are already tethered to it. When an entire industry standardizes around a single platform, communication protocol, or data clearinghouse, leaving that ecosystem becomes professional suicide. If you are an independent merchant, a logistics coordinator, or a software developer, you cannot simply opt out of the dominant network just because they raised their fees by 10%. To opt out is to exile yourself from the marketplace where transactions happen. The pricing power generated by network density acts like a gravitational pull, growing stronger and more inescapable with every single user who joins. Competitors can try to build a cheaper alternative, but they cannot replicate the accumulated trust and multi-sided liquidity that took decades to assemble. This leads directly to another overlooked layer: the psychology of asymmetric risk aversion. When a corporate buyer selects a vendor, their primary psychological motivation is not actually finding the cheapest price, it is avoiding catastrophic career regret. If a manager buys a cheap, unproven alternative to save money, and that system crashes during a critical product launch, that manager's career is on the line. Conversely, if they choose the market-leading standard and pay a premium price, no one ever questions their judgment. Elite companies with pricing power monetize this deep-seated fear of failure. They sell peace of mind disguised as software, hardware, or services, knowing full well that buyers will gladly pay a heavy financial tax simply to insure themselves against professional disaster. Yet traditional economic theory still pushes the illusion that scale solves everything, teaching that to grow, you must continuously pump massive capital into new factories, heavy machinery, and armies of workers. That capital-intensive model works fine until an inflationary shock hits, multiplying the cost of every raw material and wage simultaneously. Suddenly, the heavy giant is trapped under its own weight, where every new dollar of revenue costs more to produce than the last, squeezing margins until the business suffocates. Contrast that fragile operation with an asset-light business model possessing elite pricing power. When demand rises or prices increase, they do not need to lay down concrete, build new warehouses, or hire thousands of workers to handle the extra volume. Their digital infrastructure handles 10 users or 10 million users with virtually the exact same cost structure. The financial upside scales exponentially while capital requirements remain near zero. This brings us to yet another hidden layer: the mechanics of pricing elasticity camouflage. Companies with supreme economic moats often do not even need to announce aggressive price hikes that trigger customer backlash. Instead, they use subtle packaging shifts, tiered feature gating, or mandatory service upgrades that quietly extract more capital over time without ever crossing the psychological threshold of outright revolt. They understand human perception. People hate paying more for the exact same thing, but they will gladly pay more if the value proposition is subtly reframed or bundled into a higher tier of convenience. This mastery of behavioral economics allows elite firms to compound their margins year after year, while ordinary competitors stumble blindly through blunt force price adjustments that alienate their remaining buyers. This is the hidden engine behind history's greatest wealth compounding machines. It is not just about making money, but about how much of that money stays in the vault, entirely free from the heavy gravity of continuous reinvestment. When a company can raise its prices organically, absorb zero incremental capital costs, and watch its cash reserves swell while competitors bleed out in the trenches, it achieves a level of economic sovereignty very few enterprises ever reach. Munger spent a lifetime reminding investors to stop chasing the illusion of fast growth and start hunting for the quiet, unglamorous businesses possessing this rare genetic makeup. He knew that human nature ensures we will always pay a premium for peace of mind, seamless continuity, and absolute trust. As you let these layers settle into your perspective, look around at the choices you make every single day, the platforms you rely on, the services you refuse to cancel, and the subtle price increases you accept without argument. Behind every single one of those micro-decisions lies an economic fortress quietly compounding wealth away from the noise of the crowd. If this deep exploration of pricing power and market psychology gave you a new lens to view the financial world, take a moment to subscribe, leave a comment with your thoughts, and share this perspective with someone who needs to see beyond the surface of the market.